Thank you very much. Well, I will try not to be too gloomy, but what a time to do an economic outlook. We've had some real fireworks in financial markets. Certainly, there are some uncertainties and some downside risks, but I would say I'm cautiously optimistic about the outlook for the nation's economy and Maine's economy. I think I was here for the morning, heard all those good development numbers, low vacancy rates. Certainly, we see that in some of the economic data that I'll go through. So, there are a couple of things, I think, factors, assumptions that we need going into the year. The first, we have a very high U.S. dollar, reflecting the strength that we've had in the U.S. economy, the strength in job growth, and the recent move even in interest rates that we saw from the Federal Reserve in December. We're in an environment in which oil prices are very low, continue to tumble over the start of this year. There's some concern about what that means for the global economy. Obviously, there are winners and losers. If you're an oil producer, it's certainly not good, and we have an increasing number of oil producers in the United States, although very few along the East Coast. Pennsylvania is a little bit affected by the shale cuts, but other than that, the beneficiaries are consumers, and there are a lot more consumers than producers. So we think for the United States economy, this is a positive thing. That's the key reason why we think we will continue to see above trend economic growth, and in the United States, really led by consumer spending, consumers who are benefiting the most from the lower price at the gas pumps. We have an unemployment rate that is at 5% in the nation. We think it'll even get lower than that. And in Maine, the unemployment rate is around 4%, and we think we could get even lower than that. Inflation, obviously, partly, the lack of inflation we have right now, very much tied to the oil price. We think we'll see at least a stabilization, gradual rebound there, and a move up in wages that should help to pull up consumer price inflation. And with that, the Fed can continue very slowly normalizing monetary policy. Interest rates at the long end of the curve, which of course matter for real estate, more importantly for cap rates and mortgage rates, we think we'll see much less appreciation there, and that largely reflects this global environment that we're in, where there's a lot of disinflationary pressure. So just briefly to speak about some of these global issues, I could probably spend the whole time just talking about China. You'd have to live under a rock not to hear China every time you kind of turn on the business news. A lot of concerns about their rate of economic growth. It's obviously slowing quite dramatically. Their economy is trying to transition itself away from being a real manufacturer to having a service-based economy. Its demand for commodities have really fallen off. I mean, if you look at sort of base metals, 50% of the consumption of global base metals is from China, and we've seen that show up in terms of the real drop in commodity prices. It's also part of what we see in terms of oil, although it's not the only story, obviously, in oil. The increase in supply in the United States, as well as the capitulation of OPEC in trying to drop the price and outcompete some of the higher marginal cost producers is a big story there. But you see that commodity producers have been hurt the worst. That's been worsened by some geopolitical risks, things in Brazil. Their economy is in recession. So if you think of the kind of BRICS in terms of global growth, they were the up-and-comers in the early part of the century. Brazil's in recession. Russia's definitely in recession. China's pretty close, slowest growth in 25 years. The only economy where there may be some potential upside is India. So it's a slow global growth environment. For the U.S., that's exacerbated by the fact that the dollar has been on a pretty one-way direction higher. We've seen since 2014 about a 25% appreciation in the dollar. It's even more against those commodity currencies, places like Canada, even Mexico. We've seen over the last several years about a 40% appreciation in the value of the dollar against the Canadian dollar, against the Mexican peso. And that makes it obviously more difficult for exporters. There's some good news and bad news here for Maine. The good news is exports are less important to the economy of Maine than some of the other states and the nation as a whole. But 50% of those exports go to Canada, and the Canadian economy is facing a real hard time. Its economy was arguably in recession over the first half of this year, and they've been really hit by the decline in energy prices. So I think again, any sector exposed to that sort of global economy is hurting a little bit, is struggling. Now, in terms of oil prices, we do think we'll see a gradual recovery, but we're not going back to the days of old. I mean, the supply environment has changed. We now have Iran putting on more production, and really, I think we also have that demand in advanced economies hasn't been growing for several years. All of the growth has been in emerging markets, especially places like China, and obviously with their economy slowing, we won't see that kind of marginal demand pushing up oil prices. But again, that's a positive thing. It means that these benefits to purchasing power that we've had will remain in place. We won't get further declines in prices, we don't think. We think we're pretty close to a bottom here. At this point, it's very difficult for producers to continue to produce, especially in the United States, and we've seen a lot of evidence. Even the fact that the WTI price is higher than the Brent price suggests that the U.S., which will be importing more oil, that's a kind of a European benchmark versus an American benchmark. So we think we'll see some gradual improvement. But now, I think the good news is that if you're the American economy, it's a relatively closed economy. Exports are about 14% of GDP. If you think of an economy like Germany, it's 30%. Canada is 30% of GDP. Germany is close to 50% of GDP is exports. They're a lot more exposed to the travails of the rest of the world. The United States is not, and typically this is why you've seen economic shocks emanating from the United States to the rest of the world, and we have not seen economic shocks from the rest of the world pulling the American economy down, and we think that will continue. There are a lot of benefits even to being a flight to safety currency, as the U.S. dollar is, in terms of interest rates that shield the domestic economy from some of these pressures. So we've seen this strength in terms of job growth. 2015 was the best year for job growth in the United States since 2014. 2014 was the best year since 1999. So 15 years, we've seen very good job growth. And if you look at Maine, for Maine and especially over the second half of the year, Portland really saw job growth accelerate. It's the best year for job growth in 2015 since 2004. So we've really seen, and it looks like it's on especially if you look at the state there, if you can see that chart, it's on an upward trajectory. We think that over the next year, so in 2015 created about 4,500 jobs. We think we'll probably, on an annual average in 2016, Maine will see 5,000 additional jobs added to payrolls. That will start to slow into 2017, but we're just talking about 2016. But again, that's largely representative of structural factors. We talked about the vacancy rate in terms of industrial space earlier. Well, this is what the vacancy rate looks like in terms of employment, and the unemployment rate in the state of Maine is below it always has been below the national average, but has continued to trend lower, as I said, pushing on 4%, pretty much as low as it's ever been. And we know that there is not very strong labor force growth in the state, an aging population, more retirees, more people are exiting the labor force than will be entering it over the next several years, and maintaining job growth will come down to attracting more people into the state. I don't need to tell you that, you know that. But importantly, that downward pressure on unemployment is important in terms of wage growth. Obviously, a bit more volatility in wage growth in the state relative to the country. But we are seeing, you can't actually see it as much when you look at on a national basis. But we are seeing job growth accelerate. Wage growth accelerate, and the same thing for the state. And I think that's important because you have households that are seeing very little consumer price inflation, and even more so arguably in a state like Maine, where there is fuel oil and other things tied to the price of oil that bring down those utility costs even more, alongside signs that you're getting faster nominal wage growth. So that means all of those improvements in wage growth are real and aren't being eaten away by higher inflation. And that's really, I think, why we believe that we'll get that continued growth in domestic demand. It also will mean that if we see wage growth start to improve and we see a gradual normalization in energy prices, we will get inflation moving back up, but really not at a rate that I think anyone has to be really concerned. Some of the pop-up in the headline rate will be if we actually get oil prices moving back as we anticipate. And I would say that since I sent this slide deck a while back, there's some downside risk, I think, to that outlook in terms of how fast we see oil prices come back, which would obviously mean we have a slower rate return to target for inflation. And that's important because that's what the Federal Reserve is mandated to achieve. 2% well, they've basically have a long-term target of 2% inflation alongside full employment. We're getting pretty close to the full employment mark. I think just thinking about the Fed's calculus, what they would like to see is that the further improvement in the job market is able to attract more people back into the labor force, people who may currently be discouraged, who aren't currently looking for work, so they're not counted as unemployed. I was curious to look at the differences sort of at the state level versus the nation in terms of participation in the labor force. And while Maine has a higher overall participation rate at each age bracket, obviously the tilt of the population towards older demographics where there's less participation in the labor market, that brings it down on an aggregate basis. But we've seen the same trend in terms of the core participation rate, 25 to 55-year-olds, people who you'd expect to be working. The participation rate has been trending down nationally and in the state, and that's a lot of potential that you could see if those start to come back into the labor market. What happens is you don't see the downward pressure on the unemployment rate, but you are seeing a real improvement in the number of jobs relative to the population. There was some good news on that in the December jobs report, where you saw 400,000 people enter the labor market, which were matched by 400,000 jobs created in the household survey. There are two surveys. So if that could continue to happen, I think it's an important trend to watch, because that gives the Fed some leeway in terms of how quickly they think they have to raise interest rates. If you could see that the labor market's improving, but it's not in a way that's necessarily inflationary. Having said that, we think that we will see gradual increases in interest rates. The Fed does their own projections for when they expect to raise interest rates. They have the so-called dot projections. They expect to raise rates 4 times this year. That is would be still 4 times. Even if that projection plays off, that would be the slowest rate of tightening that we've ever seen in history, and that is twice the rate that the market is currently anticipating. If you look at Fed funds futures, there are less than 2 rate hikes priced in for this year. Obviously, that's come down over the start of this year with all the financial volatility and concerns about the global economy that we've seen. Our call is the market's probably closer to right than the Fed, and I think we will see the Fed revising down those as they have. I mean, I don't have the chart on here, but you've seen consistently the Fed have to move down their own expectations for when rates are normalized. Again, that's contingent on the inflation outlook moving upward, and on the economy continuing to improve as we anticipate. They say over and over again we are data dependent. For the real estate market, we care more about sort of long-term rates. And on the long-term scale, really, it's not just the Federal Reserve that matters. We see, obviously, as anticipation of future rate hikes get priced into bond yields, we see some upward pressure on bond yields. But the global environment is more important here. And in an environment in which there is fear and uncertainty and deflation, disinflation, excess capacity, you tend to see long-term rates not moving up, even as the Fed may be. So, if you look at rates around the world, I mean, in Germany, the 10-year bond yield is 0.5%. In Japan, the 10-year bond yield is like 0.2, I don't know what it's between 0.2 and 0.3%. So those are very low rates, and they are being translated into, you can get a higher return if you're a global investor investing in U.S. Treasuries, which is the biggest bond market in the world. So that's going to keep some, I think, continued downward pressure. In fact, since we made this chart, we've seen the 10-year yield fall below 2%. That's that flight to safety, fear in financial markets resulting in lower bond yields. But there are, as I said, some positives to that. I mean, lower interest rates show up in terms of lower mortgage rates. Lower mortgage rates encourage refinancing. That's additional income for households, and also supports a market that is almost completely shielded from global pressures. You think about the construction industry, and you're not importing homes to any large scale from anywhere else. Those are local jobs and that's local economic activity. So I think having this kind of, as I said, global environment, it's hard to kind of look past some of the gloom that we hear on the news all the time. But I think there are some positives, especially because the construction sector, nationally and in the state, is nowhere near what it was, and I think still has a lot of potential upside. If you look at sort of housing starts in Maine, there have been around 3,500 housing starts really over the last several years. It hasn't really moved, and we think that probably should move up by 2016. We think we'll, maybe not in 2016, but by 2017 we'll be at 4,500 housing starts, and that creates. If you look nationally, I don't know the numbers at the statewide, but there are still 1 million fewer construction jobs than there were prior to the recession. Now, we're not going to get back to the boom that we had in construction. Obviously, it was way overbuilt prior, and prices were out of whack. But the population's growing. The population's growing. You have 2.4 million people nationally every year, and you should have about 1.5 million housing starts. There are only 1.1 million as of the last data, so that's still 30% potential upside. Okay, so I kind of stated what this means for interest rates. I would say that at the front end of the curve, if I was putting the slide together today, I'd suggest that we maybe don't see quite that level. We don't get quite that high in terms of the short end, and perhaps even lower in terms of the long end. But you can see the short end coming up faster than the long end due to those global pressures. So in terms of the housing market and home prices, you had seen a pretty sound initial rebound in home prices pretty much around the country, including in the major counties urban counties in Maine. But we've seen that really start to slow, and that slowing, I think, is not necessarily a negative thing. That you want to have home prices growing at a rate that doesn't put pressures on affordability. I think some of the initial rebound or rise in prices was driven by investors, was driven by people who were seeing opportunities. One of the differences between Maine and the rest of the country is there is a higher level still of delinquencies and foreclosed properties that could come onto the market. Now, that has been going down at a pretty swift rate, and the gap between sort of the rest of the country and the state has been declining. But that's something that probably will put some pressure on the rate of home price growth. But again, really, we're pretty undersupplied in terms of construction, and I think there's scope for that to continue to rise. That extra supply means that you don't have to see as much home price appreciation, but you see it in terms of greater construction activity. I'm a little bit. I still have some time to talk, but I don't know. Maybe could I take a few questions? Is that all right? Okay. So if anyone has any questions, I think there are some mics set up, actually. Don't be shy, please. Well, okay. Oh, there's one right there. Oh, geez. Well. Next question? No. Well, I can't. I'm. Oh, the question was thoughts on the next election. I can't comment because I don't know if it was. I'm from Canada, so. Um, yeah, yeah. We had our election. We kicked out our old government, put in some new people. Um, like gasoline prices or heating. Right. Yeah. Well, I mean, they will follow I think, quite closely. I don't know the levels per se as much as the trends and the growth rates follow quite closely. So the question was about consumer energy prices. And again, I think that we should see them come off the lows that they're at right now. I mean, we're at 12-year lows for, even for gasoline. They're probably, even as oil goes down, there are certain costs of running refineries that you can't, it becomes a little bit nonlinear in terms of passing on the gains of lower oil prices as you kind of mentioned. But I think that just as we sort of have this equilibrating of supply and demand in the broader energy market, I think you'll start to see you'll see a slow appreciation in consumer energy prices. Yes.
I know that some of the major insurance companies are becoming more and more concerned with climate change and its impact on economic development.
Yeah.
Do you have comments related to that on that subject?
Well, I mean, I think they're right to be concerned. Certainly, we have an insurance. Oh, the question was about concerns about climate change, especially for the insurance industry, and its impact on the economy. And what I would say is I think there's a growing body of evidence that the volatility or the frequency of sort of disasters of high cost of, I'm not sure the insurance term, but high-cost events, weather events, is increasing in frequency. And I think that's probably, I'm not a scientist, I'm an economist, but it's probably related to some of that. And certainly taking efforts to move the economy away from fossil fuels, I think, is probably beneficial in the long run. That's kind of the downside of low energy prices, actually, is some of those efforts we see consumption of energy rise as the prices are lower. So that's the downside there. Okay, well, thank you very, very much for your time.